Well, a global recession is likely if the coronavirus becomes a pandemic, and that's according to a new report by Mark Zandi, Moody's analytics chief economist. He did raise the odds of a pandemic to 40% from 20%, and he joins me now on the phone. What does that do to growth? We have seen a lot of talk about companies starting to re-rate and how they're looking at the end at the year. How do you look at the global growth landscape?
Well, if the virus jumps and it's a pandemic, a global pandemic, then I think we have a global recession, which means the global economy will contract. We can already see how disruptive this is in China. The Chinese economy has effectively shut down, and the economy will shrink in Q1. So if this is symptomatic of what will occur across the globe, which it probably will be, then that means a recession. That means economic activity will decline.
So, Mark, Mohammed Al-Arian had a good quote out in a Bloomberg opinion article earlier today talking about the difference between what we're hearing from companies versus the lack of global growth downgrades. So when would we see these downgrades start to happen on a global growth basis versus just a company basis?
Well, I think it's going to start showing up in the economic data now. It's already, you can see the leading edges of it in some of the PMIs across the globe. But I think I'd be pretty surprised if we don't see it starting to show up in the economic data in the next few days, next few weeks. Certainly, governments, global policymakers are responding as if their economies are at risk of going into recession. I mean, you can see what the folks in Hong Kong are doing, Singapore, Thailand, China, central banks almost everywhere. So policymakers are acting as if this is going to be a big hit to the economy and potentially a recession. So I would expect it imminently.
Are the steps that the governments are taking enough? I was struck by the Rio Tinto CEO earlier on a call basically saying that China's not going to be able to stimulate like we may think that they will. Is it enough?
Probably not enough to avoid a recession. That's one reason to be nervous here is that there's just a lot less room to maneuver for central banks. Interest rates are very low. I mean, Europe is the poster child for that. I mean, negative interest rates, there's really no policy response there. And then on the fiscal side, there's more room, but not as much room as we need, again, because governments have run up big deficits in debt in recent years post-financial crisis and just don't have the room to maneuver. I think the most significant, though, concern would be around the transparency governments provide to us as this becomes more of an issue. If governments hunker down and become opaque, aren't transparent, aren't telling people and markets what exactly is going on, and people stop trusting what they're hearing from governments, that's going to be that's going to be a very significant problem, particularly for financial markets.
The rhetoric was, say, a year ago, if we did get a recession, it wouldn't be that deep because you did have sort of reaction function from the Fed and lots of liquidity. If we do get this situation as you play out, how deep can this recession look like?
Well, it obviously depends on the virus and how widespread, how virulent, how long-lasting, but I've always skeptical of that logic that the recession would be short and shallow because of that policy response. I mean, historically, just take the Federal Reserve. In a typical recession since World War II, the Fed lowers interest rates by 5 percentage points, while the funds rate today is 1.5%. So that just gives you a sense of the lack of room here to maneuver. So I think if we go into recession, we need to buckle in because it's going to be pretty tough to get out.